You guys can hear me clearly. Okay. Okay. Like we have a every webinar. Hopefully you guys can hear me clearly. Like there's one or two little people still battling to log on. The idea of this webinar is obviously to introduce you the basics. So here's the agenda as such. The first part is I'm going to just give you a quick overview. What is a stock exchange? What are shares? The different classes of shares, and the pros and cons of getting involved in the market. So just to give you a quick overview. I understand quite a few people are quite novice or new to the market. So that's the objective, just to give you a quick overview. And then those of you that have been involved for a while or have been betting along, I just want to explain to you how to choose your first shares, and I've tried to simplify it into four simple steps. So the presentation is in two parts as such. Okay. Just remember this presentation, as I say, will be sent out to you guys. You'll get the presentation and the recording. The idea is that any questions you have, please send it through to me. I prefer it better if you can also ask questions on our Facebook page, so everybody around the country can also learn from it. Okay, so let's get started. This presentation is based on the online tutorial, Share Market Basics, or Introductory Topics. So if you go to our, before logging in, you'll find there's a button along the top called Resources. If you click on our resources, if I highlight it there for you, there we go, that's our resources there. On the next page, click on the tutorials, and this is where you'll find it. So it's an online tutorial. You can read through the stuff, and that's the content is based on that presentation. So it's an additional resource for you to learn about the market. And there's a whole lot of other tutorials that you can learn more about the market as such. Okay, let's move forward. What I'm going to discuss is just the basics, introductory topics, and then let's kick off with what is a stock exchange. Basically, it's a forum or marketplace where shares in listed companies are bought and sold. So there's two parts to it. Number one, a company would be listed on the stock exchange, and obviously would issue shares in its company. So the idea there, from a company's point of view, would be to raise capital, either finance future expansion projects or to reduce the debt. But you as an investor have the opportunity to become a part owner of that company. You do that by purchasing shares in the business. But just understand that the company does not get any further benefit once it's listed on the stock exchange. We talk about a primary market. This is where the company comes and sells the shares to the public to raise funds. But what's more important is what you call the secondary market. This is where the public buys and sells those shares between ourselves. So it's important that we have a good secondary market. And the idea there is that you want to have a healthy secondary market, because I want to be in a situation where I can sell the shares if I want to. I know there will be a willing buyer in the market. So the two markets run next to each other, the primary market and the secondary market. So the idea is that you as an investor want to be able to divest or sell your shares at any time, preferably to realize a profit. That is if you're selling the share at a higher price than what you originally paid for them. And obviously you must also take into consideration the costs. So that is a quick introduction to the stock exchange. You must understand there are stock exchanges all over the world. Obviously New York Stock Exchange is one of the biggest. You can see there's a little picture of the New York Stock Exchange, and it's quite interesting in the sense that it runs two markets right next to each other. You've got the floor, and also you've got the online screen trading. But obviously that's the biggest market in the world, more than 8,000 shares listed on the New York Stock Exchange. The JSE, if you look on the far right hand side here, that's what the front of the JSE looks like. And obviously we've got very close ties to the London Stock Exchange, and we understand there's stock exchanges all over the world. Okay, so what is the role of the JSE? What is the role of the Johannesburg Stock Exchange? First of all, they provide a regulated trading platform where buyers and sellers can trade shares. When I say regulated, obviously there's rules and things in place, and bottom line is there to protect the investor. So there's rules and regulations to protect the investors, but also obviously the market players in the sense of the institutions and the stockbrokers and things like that. So the JSE guarantees all trades that are transacted on the JSE. So we talk about listed shares. So as long as it's a listed share, if something goes wrong, there's some recourse. Say, for example, a stockbroker runs off with your money, you've got some recourse. So that's where we talk about the trades being guaranteed in that. So obviously through the JSE and on the online platform, you have a wide choice of companies to choose from, and also various financial products to have access to the stock market. But bottom line, the JSE's main aim is to provide an active and liquid or tradable market. Okay. So, by the way, any questions you guys have, type them up, and I'll try and answer them as we go along. But ideally, I'll be answering a lot of questions near the end. The question here, let me quickly handle this. This Connect, the presentation will be available. I'll send you the link, and I'll send you the recording tomorrow, or hopefully in the next few days. Okay. So remember, the presentation is being recorded, and you will be getting the PowerPoint presentation. So we talk about the relationship with the London Stock Exchange. Let me give you some background regarding the JSE. I spoke just now about the New York Stock Exchange and the floor. We had a trading floor until June 1996. That was replaced by the automated trading system. We can talk about a computerized system. And that system, at that point in time, was called the Johannesburg Equities Trading System, or JET. And that was designed by the Chicago Stock Exchange. Now that system was replaced in 2002 by the London Stock Exchange automated trading system, and that's called SETS, Stock Exchange Equity Trading System. The idea there is that we've gone from a stage where once upon a time we used to have share certificates, paper share certificates, and now we've moved over to electronic version. So that process was called dematerialization, and we migrated over to electronic settlement system, and that settlement system is called STRAIGHT, and STRAIGHT stands for Share Transactions Totally Electronic. And the whole objective there is to provide rolling, contractual, and guaranteed settlement for all securities, and that the whole idea is to take place within what they call T+5, 5 days after the trade. So the whole idea about the centralized order book, it's order driven. So buy orders are matched to sell orders on a computer screen. So it's just much faster nowadays, and obviously we don't have to worry about signing any forms and sending it through and getting lost in the post. Everything's done electronically now. So it creates a lot of more capacity, but there are a lot more other advantages. There were improvements for the investors, listed companies, as well as the JS itself. Bottom line, increased investor protection. There's more transparency because there's a paper trail now. There's more increased capacity. We can do more trades. The average on the market is about 15 billion a day. We've been as high as close as 25 billion. So the idea here is that when I say investor protection, there's real-time surveillance, there's security, and as I say, provides that audit trail. One of the other things that came through after this whole changeover, the Big Bang, as we call it, stockbrokers were allowed to acquire shares and then sell them to clients. And in that instance, the stockbroker is acting as a principal, as opposed to an agent or a middleman between a buyer and a seller. However, most stockbrokers have chosen not to go that route, and they prefer rather to be an agent between a buyer and a seller. Okay. So most of the trades in the market, if you go through a stockbroker or agent. So what are shares? Okay, we spoke just now about as companies expand, they require additional finance to expand their products, and they need to raise additional capital. So they do that by selling shares in the company to investors. So each share represents a part ownership or portion of that ownership in that company. So each share entitles you as a shareholder to a vote on important corporate matters like at the AGM and things like that. You can vote who manages the company, directors and things like that. But also you have the right to receive dividends if and when the dividends are paid. So you as an investor who purchases shares in the company will be called a shareholder. So for example, Sasol shareholder, whatever the case might be. Shareholders may receive dividends only if the board of directors declare dividends, and it's only from profits. Remember, you can only pay dividends out of profits, not out of capital. Okay. Shares are also known, there are different terms. They're known as equities. I like to use the word equities. It reminds me that we share equally in the profits and in the losses. Okay. but Americans also like to use the term stocks, and a lot of times people use the word securities, but securities can encompass all financial instruments. Okay, so there's a direct relationship between the number of shares you own and your portion of the company. So the more shares you own in the company, obviously the greater percentage of the company you own. Okay. So there are different classes of shares. Majority of the shares traded on the JSE, we talk about ordinary shares. So ordinary shareholders have the voting power and ultimately the control of the company. Okay. But you have no rights to any profits until such time as dividends are declared. Okay. So you share equally in the dividends as and when they are paid. So only if there's a profit. And I know I'm hopping on the case, but sometimes companies might not pay out any dividends. Sometimes a company might reinvest all the dividends back into the business because it's one of the cheaper options for a company to expand. Okay. So most companies on the market are ordinary shares, but they can also issue other classes of shares, and we'll talk about those now. But always remember, we always trade in ordinary shares. We also get what they call a preference share. The difference between a preference shareholder and an ordinary shareholder is when it comes to dividends. A preference shareholder will get paid dividends first before an ordinary shareholder. So they have prior claim as such. If the company go into liquidation, they'll also have prior claim. Okay. So the idea is that this is more for the investor who's looking for a income. So you're looking for a regular income and a stable income. The biggest disadvantage with preference shareholders is that you do not have the voting power. Remember, who has the voting power? Is the ordinary shareholders. So this is for preference shareholders for someone looking for medium risk and return, but obviously the risk is slightly higher than debt instruments, but lower than ordinary shares. So it's a nice way to add onto your portfolio, especially looking for income and things like that. That's what a preference shareholder would look for. Okay. The third class of shares, we talk about debentures. This is basically a loan to a company. Instead of going to the banks, the stockbrokers, the companies can come to the investors and say, I want to borrow money from you. So it's a fixed, what they call a fixed interest-bearing security issued by a company. It's a loan contract. It's a promise to pay the capital or the principal plus interest at regular intervals. Okay. So it's very similar to a fixed bank account. You pay interest, but you don't get dividends. Okay, remember, by the way, interest is taxable. So just take that in consideration. There are various classes of debentures, same with preference shares. I'm not going to go into too much detail. Just understand the ones that we trade, the class of share we trade the most all the time is ordinary shares. Okay, I just want to be aware of the other three classes as such. And they're all listed on this. If you look at this newspaper, you'll find they're all listed there anyway. So we've been talking about shares. What are dividends? Where a bank deposit will attract interest, shares attract dividends. Okay. So dividends, remember again, are only paid out of profits. Now this can either be a cash dividend or a scrip dividend. In other words, instead of paying you cash, they can issue more shares. So that is usually occurring where a company wants to preserve their cash flow and things like that. Okay. So dividends don't have to be fixed. But it depends on the discretion of the directors of the company. Okay. So dividends are declared every 6 months. You get an interim dividend for the first 6 months of the year, and then you get what they call the final dividend. That's for the whole year. Okay, so that's based on the actual trading results. So you look at basically getting income twice a year from a company, if and when they pay dividends. Okay, that's one of the things you're looking for when you're looking at not only growth companies and undervalued companies. You're looking for companies that are paying out regular amount of dividends because that's what investors are looking for. So you will see there's demand for those kind of shares. Okay. So why do you want to invest in shares? A lot of people have the impression that you need large sums of money to invest. No, you don't. We'll talk about the cost now, but you can go invest at PSG. We don't have a minimum amount, but you can take into consideration the costs. You can go invest as low as R1,000 if you want to, less if you want to, but remember the cost, and we'll talk about the cost now. So remember, obviously you want to get involved in the company as a shareholder, but you have to be physically involved in the day-to-day running of the business. Okay, so that's one of the biggest advantages. A lot of people always want to have their own business. Now you've got an opportunity to be involved in business without having to manage the business. Okay, so the nice thing is you can build up a portfolio between 8 and 12 different shares, and that's how you can start being a shareholder as such. Bottom line, there are risks involved And the idea is while you're learning about the stock market is you want to have a sound investment approach. So you want to bend the odds in your favor by learning more about the market and about shares and such. So that's how you can minimize the risk in the first place. Your first investment I always say, is investing in yourself. So if you can invest in good quality stocks that will generally give you a higher return than endowment policies, you're doing okay. Okay. So we'll go through that process just now in more detail. You have various rights as a shareholder. You're right to receive the dividends. You have the right to vote. You're allowed to have equal treatment at all times regarding if you're controlling or a minority shareholder. Everybody gets treated the same. And obviously, you need to be kept informed. There's a lot of information out there. We talk about the stock exchange news service. Any price-sensitive information has to be disseminated through the stock exchange news service first of all. Okay. So that is giving you a quick background. Let's talk about dealing costs and tax implications and things like that before getting to the more nitty-gritties. At PSG Online, we work on a trading scale. We start at 0.9% for a transaction up to 25,000 Rand. But our minimum cost is 98 Rand per trade. Okay, so coming back to my example just now, on 1,000 Rand, as a percentage, 98 Rand, your shares have to move up 9.8% to break even on costs. So it might take you a few days, or it might take you a week or so, but I always suggest that people save a bit more, make sure you try to get your transactions a bit bigger. So let's, for example, it's not about making money on the market, it's avoiding capital losses. So, a nice amount to start with, I would say, is minimum of about 10,000 Rand. So the idea is that you want to buy 4 different companies, spreading your risk. So allocating 2,500 Rand to each share. So your cost as a percentage then drops down to about 2.5%. And the share market, on average, can recover those kind of costs in 2-3 days. Okay. So that's first of all, is your brokerage commission, the brokerage. And there's obviously that on the brokerage. On 40% on the brokerage. And there's also what we call mandatory costs and other charges. There's what they call a securities transfer tax. It's a government levy. It's only charged on the share purchasing or the opening leg of the transaction. So it's 0.25% of the value of the transaction. So just remember, there's no securities transfer tax when you sell. So this is just a government tax on buying and selling or buying shares as such. We spoke just now about settlement costs. There's a cost involved, obviously, to handle these electronic transactions. Minimum of 10.92 Rand at PSG and maximum of 54 Rand. Okay, that's per transaction. And then we spoke just now about the surveillance in that. There's what they call an investor protection levy. Very small percentage, it's a few cents every time. Obviously, that goes towards that surveillance department. Okay. You need to ask yourself 2 questions. Am I an investor or trader? I suggest you be both. So the idea is that you have an investment account, a capital portfolio to complement your share portfolio, to complement your retirement fund or your pension fund, and have a trading account. A trading account, I call that a fund money. You want to go on holiday, you need to buy a new car in a year or so's time, get the stock market to do for you. So ideally is to have 2 accounts. You'll see also just now when we talk about tax from a tax point of view. So you can say to the receiver, this is my capital portfolio. I haven't sold any shares. There's a paper profit, but I haven't realized any profits. So you can't tax me here. So that's what they call a capital portfolio. On the other side, your trading portfolio is your income portfolio. So yes, the income is taxable, but I always believe that I'd rather have a tax problem than a cash flow problem. And I always joke, would you like to have Bill Gates' tax problems? So don't worry about it. But the best way to do it is just to have 2 different accounts. So let's talk about being an investor. The idea, the difference between an investor and a trader is your time horizon. So the longer your time horizon, then you're investor. So we talk about being passively involved. So you can be involved as a passive investor through unit trusts. You're not going to be involved buying and selling all the time with unit trust. Obviously, that's not the instrument for doing that. In this context, I'm talking about shares, being an equity investor. So we talk about being a passive manager. You're tweaking your portfolio, maybe, or looking at your portfolio maybe once a month, as such. But your time horizon is 3 years plus. So gone are the days that your long-term view is 20 years. Now we talk about 3 years plus. So your strategy is a buy and hold strategy, and your focus is on good quality, undervalued shares. And your goal is to build a balanced portfolio. When I say balanced portfolio, is to have some financial shares in your portfolio, some industrial shares in your portfolio, and depending on if you like it or not, some resources or mining as such. But the idea is that that you're going to take advantage of the rand. If you anticipate rand weakness, have some element of rand hedge in your portfolio. And that's why I like the resources, shares like Sasol and things like that. Okay. But your main goal as an investor obviously is capital growth. People always ask me what's a reasonable kind of target to go for. My personal opinion is that it should be outperforming inflation and as well as the bond market. So you're talking about 6% and another 6%. So that's about 12%. I like to round it off to at least 15% plus per annum. That means, you know, every 3 or 4 years you should be making at least 50% compounded. Okay. I believe, you know, again, it's personal opinion. If you're not making 15% per annum on your whole portfolio, you know, you're wasting your time. Rather be in unit trust or something like that, or exchange traded products. You're changing your time to be more actively involved in this. So, you know, you want to make it worthwhile. And that should be a good goal to strive for, at least 15% growth per annum. And the idea is to do it consistently, year in and year out. Okay. Obviously, that's the minimum I look at. You know, you want to try and do much more than that, but that's what your goal. Secondly, you're looking at dividend income and growth in that income. That's another way of compounding the growth in your portfolio. So reinvesting that money back into the portfolio, buying more shares. So the advantage of being an investor, if I buy once and I don't sell, I get very low brokerage costs. Secondly, when it comes to tax, if I buy a share now and I hold it for at least 3 years, after 3 years I decide to sell, that's when capital gains tax applies. So obviously a much lower rate than income tax, but maybe you have to hold the share for at least 3 years. After 3 years I decide to sell, whatever the reason might be, let's say capital gains tax will apply. And there's an example on the next slide. As a trader, obviously, as you can see, it's more active management, so it takes more time to be a trader. I just done the opposite now. Your view will be less than 3 years. And there's different styles of being of trading styles as such. We talk about position trading, and I put that first because that's just one step down from being an investor. That's what what I call an active investor. You're a trend follower. I'm a position trader. I trade the long-term cycles, but I'm taking advantage of the cycle as such. So you might hold it from a few weeks to a few months to a few years. That's what we call a position trader. But most people will be what they call swing trading, holding a position from 2 days up to 30 days. That's more applicable to the derivative market, like single stock futures and CFDs, but some of you guys might want to do it with equities. And then we also get what they call jobbing. I call that day trading. It's in and out the market intraday. Obviously, you need more time to be watching the market. And that's where the Aussie futures come in handy and the currency futures. Someone that doesn't want to hold a position overnight is what we call a day trader. So still your main goal is still capital growth. We talk about taking advantage of the cycles. So you want to buy low and sell high. Alternative, especially with derivatives, and we talk about it it's in an upcoming webinar. You can use derivatives to take advantage of a falling market. So with buy low and sell high, you buy something at 5 Rand to sell it at 10 Rand. Do the opposite of derivatives. You sell at 10 Rand to buy back at 5 Rand. You're still making 5 Rand. So it doesn't matter which way the market's going. You can still, as a trader, take advantage of that. But obviously there are pros and cons. If you're buying and selling all the time, understand there are more costs involved. And obviously income tax comes into play. So here's the example with capital gains. Remember, this is a scenario. You've held a share for more than 3 years. After 3 years, decide to sell. Let's say, for example, in this example, you made 100,000 Rand capital gain. Your first 30,000 Rand of profit is exempt from tax. You don't pay tax on the first 30,000. So in this situation, we get a 70,000 Rand taxable gain. So the SARS works, or the receiver works, or what they call an inclusion rate. It used to be 25%. They bumped over up now to 33 1/3. So depending on your income tax bracket, let's take the highest here, 40%, the 33 1/3% of your taxable rate. In this situation, the maximum you'll be paying is 13.32%. That, as a percentage of your 70,000, equates to 9,324 Rand. So that's, you make 70,000 Rand profit, but 9,000 Rand has to go to the receiver. Okay. So the idea is that I'd suggest you keep your nose clean. If the tax is due, pay it over. Okay. But there's a whole tutorial on tax anyway. There's ways and means also minimizing their tax with other costs and things like that. You can, the cost that you use to generate income, you can minimize it. I'm not going to go into too much tax now. So what I always suggest to people, never buy shares on tips. The whole idea is someone's giving you a tip. I always ask myself the question, why? I always believe in researching the share. Would you have bought the share without the tip? If the answer is yes, then it's a good tip. That's after doing the research. I always like to write down the reason for buying the share. In other words, the more reasons I have, the more homework I've done. If it's the only reason I've got is I've got a tip from John, your red flag should be waving. Okay. The idea is with hindsight, you can learn from each experience. And the idea is that you'll be making mistakes, and the idea is to pinpoint or highlight where the mistakes was from. If that process, through the initial process. Biggest enemy in the share market is human emotion. So never be greedy. Don't let your emotions rule. So the idea is that you want to be objective. Okay. Sometimes we get married to our winners and we snub our losers. So when it comes to shares, never borrow never borrow money. People go take money out of the bond to buy shares. What happens? The market goes against you. Maybe you have to pay that money back, and it's not a good thing to do. Different scenario with derivatives. Obviously, more advanced traders get involved there. It's all risk management, but never invest borrowed money. Okay, we're talking about money. This is forever savings, money putting aside to invest for your financial future. This is what we're talking about. Okay, so guys, we're running out of time. Let's get into the more of the nitty-gritty side. Let's see if there's any more questions coming through. Stuff we've been talking about. Is 1,000 Rand good enough way to start? A trading account. This is a question from Mululani. Yes, you can, but as I say, just remember the costs. Your cost is more than say is nearly 10% if you had to bring in VAT and all that kind of stuff. 9.8% on 1,000 Rand. What are the other questions there? And other questions. Okay. But guys, keep them up as we go along. Any questions, and I'll answer as we go along. So let's get into the more important part. I always find people feel overwhelmed. They don't know where to get started. They open the share price page, and I think, geez, which share must I buy? So the idea here, and I've been doing this for 20 years, and it's a simple process. You don't feel overwhelmed, and as you get more knowledge and experience, you tweak it, and you fine-tune it and fine-tune it. But the process to choose your first shares, and it doesn't have to be your first shares. How do you choose the shares for the next week coming up to trade? Or if I get some spare cash now, how do I go buy? What shares must I go buy? That's the question you always want to answer. So bottom line you want to do is narrow down the choice. So if you open the share price page, as I say, there's more than 400 shares listed on the share price page. We're going to go through the process of what I call prospecting. I stole an idea from the mining industry. The good old days we used to pan for gold, in the riverbed. We used to go through a lot of gravel to get to the gold nuggets. So the process here is to focus on the gold nuggets. What criteria? What does the gold nugget look like? What is our ideal share to look for? So that's the process I'm looking at here. So we're going to talk about two processes as such, what they call a top-down approach, and using financial journalism. You can also use fundamental analysis and technical analysis. There are 4 different methods to help you prospect and find an initial list of shares. And the idea of that initial list of shares is to create a watch list. Now that watch list, that's where the website comes in handy. And on our website, we allow you to create 3 different watch lists, 30 shares maximum in each. But you don't have to have 30 shares in each. I suggest make that list smaller. The smaller the list, the better, more manageable. Once I've got that initial watch list, obviously I'm going to go through the second part now, what I call analysis. We talk about fundamental analysis and technical analysis, and 2 approaches of analyzing shares. So this is how I can start focusing on the gold nuggets. And my goal ultimately is to get to the stage where I'm choosing shares either for my simulator, especially for those that are novice investors and traders. Before trading real money, I suggest you learn to use our trading platform on the simulated environment. But the idea is ultimately to get to a stage where you've got between 8 and 12 shares. It's a trade-off between risk and time. You want to have 2 little shares or your eggs in one basket. You want to have too many shares, then you have to spend time analyzing all those companies. Okay. We talk about diversification. You want to spread your risk around. Okay. So we spread between 3 and 5 different sectors, and across 8 and 12 different shares. Okay, so if the financial shares, if the rand gets stronger, the financial shares will do better. If the rand gets weaker, your rand hedge stocks like your miners and your exporters and companies that have operations offshore will do better. That's why I say you need to have some element of rand hedge in your portfolio. But you don't want to put all your eggs in gold, all your eggs in platinum. You'd be crazy to do that, especially with this current uncertain environment. Okay, so that is the idea, is that you'll have certain criteria for buying, and there'll be certain criteria. When would you sell the share in your portfolio? So there's no, it comes to a day where the share price has dropped 50% and now you decide to sell. You need to have those rules in place. When will I sell the share? If you're looking from a perspective of a long-term buy and hold strategy, my criteria is that it becomes overvalued. On our trading research platform, we use an indicator called the PEG ratio, and it's all color-coded for you. So if it becomes overvalued in that situation, then that's where I'll put a 20% stop loss, because now it will fall off, it will pull back, and if it pulls back more than 20%, you get out. Okay, that's one criteria I might use. Another criteria is that I like Sasol, for example. It's not only an oil company, I look at it as an intellectual capital company. But this is, for example, they change their nature of business. They're not going to be involved in petrochemicals anymore. They're going to start selling cell phones. My original decision for buying a share has changed. That might give me grounds to sell the share. Or the company might come out of bad results, and I can foresee it, that this might continue for a while. I might say, well, there might be a bit of opportunity somewhere else. But the idea is that you have this all detailed written down for yourself. It's like a business plan. It gives you that guideline. Okay. So the shares move out of your portfolio, they move back into your watch list. Every time the shares in your watch list might be suspended. No use in having a share that's suspended in your watch list. You want to discard it. So this is a process where if I drop something off, I want to reinvest it again. So as it never stops. You want to focus on the potential winners, and you want to tweak that watch list until such time that you know everything about those companies in your watch list. You know what industry they're in, you know the impact, what the factors impact that industry, what impacts the share itself, the company, all that kind of stuff. The more you know about a certain company or industry, the better your chances are in the market. Okay, so let's move forward. So let's talk about narrowing down the choice. How do you do that? Now, instead of looking at 400 companies, we simplify the process and we can look at the top 100 companies. That's the same list that shares that we trade on CFDs and single stocks. We call that simulator list. So we talk about the two processes now called the top-down approach and financial journalism. Remember, my goal is to create an initial watch list, and from there I'm going to tweak it. So once you've registered on our website, you might be able to go for a free trial, a 30-day free trial. You'll have access to our trading platform, the simulator, but also the research tools and things like that. But you log in, and on our page you'll find there's a little button called Indices. On Indices, you'll open this page, and then you need to click on the Futures page. And on that Futures page, there's various tabs. You want to find the tab called Simulator. Now, the reason why I suggest you click on Simulator is, first of all, you can see on the far left-hand side here is a whole list of codes, okay, share codes. You need to understand what those codes are. You need to know what is, for example, Barlow share code, BOW, and Sasol share code, SOL. So what I suggest you do is you print out this list. So you'll have it listed with you. Secondly, you'll get an idea, for example, African Bank, right up top, ABL, there says African Bank, and in bracket it will tell you what sector it belongs to. So you can actually start familiarizing yourself with some of the shares in the market. So as you go down this list, I can stop just ticking them off and say, okay, these are the shares I want to put into my initial watch list. But I suggest you print that list out. This is a strategy I use every day. We discuss it at traders forums and things like that. I call it the top-down approach, or going from the general to the specific. Imagine a funnel, lots of information going up top. You'll have some filters in place, and a little bit of information comes out the bottom. I like to use technical analysis and charts to help me look at the trends of various things. So I look at the international markets. I look at what's happening in the States. Obviously, that's the biggest economy in the world. We look at the Dow Jones, the top 30 companies in the States. What's a trend for the last 6 months, the last year, last 5 years, and so it goes on. Is the market going up? Is the market going down? Or is the market going sideways? That is your goal at this point in time. What is the trend? So we look at the States, we look over to what's happening in China, so we look at Hong Kong, the Hang Seng Stock Exchange, go over to Europe, look at things like the DAX, the German market, the CAC 40. We look at things like in London, London Stock Exchange, the FTSE 100. But ultimately, you want to formulate an opinion. Is the market going up or down? What is the sentiment? Because that's what moves the market. Is the sentiment bullish? Are there more rising prices or falling prices? Okay. And that will have impact on the JSE. If all these markets are going up, that will have impact on the JSE. So that's what you want to try and anticipate. So within those different economies, different countries, you will have a view on economic indicators, things like inflation rate. What's the level of inflation? What's the trend? What's the level of interest rates? Is it going up or down? Worldwide, inflation is under control, but there's pressure for inflation to go up. And one mechanism that they use to control inflation is interest rates. And that's where the relationship with interest rates and the stock market is like a seesaw. As inflation starts going up, you'll find that interest rates will start going up. And as interest rates go up, the stock market comes down. So imagine a seesaw scenario. But if you go through all this process, have a view on what's happening with the exchange rate. What's happening with the dollar relative to the euro? What's happening with the dollar relative to the yen? The rand relative to the dollar, rand relative to the euro. Okay, so it gives you an opinion: are we getting stronger or weaker? Is the rand getting is it undervalued or overvalued? So coming back to what I said just now, you have to have some rand hedge element in your portfolio. So it's important to have a view on the exchange rate. What's happening with the gold price and the platinum price? Ultimately, you want to take it all into context and say, okay, how does that affect the local market? When I say local market, it's JSE all share. You can break it down by industry. Look at financial shares, industrials, and the resources. Within those different industries, you want to look at specific sectors. So within the financials, we look at the banking sector, and in the insurance sector, and the listed property. Within the banking sector, I go look at First Rand, and I go look at Standard Bank and Nedbank and things like that. Ultimately, I get to the stage now, does the share meet my criteria? And that's where the checklist comes in, the fundamentals and the technicals. Okay. That's one way of finding interesting looking shares, is using a top-down approach. As I say, I like to use the charts. Then I read in the newspaper, why did the market go up and down? And this is where financial journalism comes in. So, yes, you have to do a lot of reading to keep your finger on the pulse. You can either read the websites. There's Bloomberg, there's Reuters, there's CNN Money. You also use the newspapers. You know, I like to use the Business Day, the physical newspaper, but also use the Business Day's website. There's weekly publications like Financial Mail, FinWeek, there's Finances and Technique, and things like that. If you don't have time to watch the market on a regular basis, and then maybe the worst case scenario, look at it on a Sunday. Look at the Sunday Business Times. But obviously you're not going to be so actively involved in the market. And obviously there are a lot of local websites you can look at. PHG Online, we provide a lot of tools, information there, MoneyWeb, Fin24, etc. If I can give a word of advice, be very selective in what you're reading. Because you can get to a stage where you have what I call analysis paralysis, where you have information overload. You're going to try and track everything, and it's impossible. So you have to be selective. What I always find useful is create my watch list first, and once I've created a watch list, all I have to do is scan for the shares, or scan the headlines and look for the shares that's in my watch list. And then go back and read those articles. Okay. You have to read everything on the newspaper, everything in the newspaper. Okay. One way to pick up opportunities also is to look for bad news. Why I say that? Where do you think the shares on the cycle? The top of the market or the bottom of the market? Most of the time we'd be at the bottom of the market because it's been discounted. People have sold off a long time ago in anticipation of that bad news. Now you can go read up about the company and say, okay, will this be a recovery situation? What I always do is the share price page of the newspaper. There's a page after that. We look for top 10 up and top 10 down. Those are opportunities. Also look for new highs, new lows. That also gives you opportunities. Okay. So this is where it comes to the watch list. When you go back into the website, I believe this is the starting blocks when you're first looking at trading or investing, creating your watch list. That puts you in the starting blocks. So when you first go into the watch list, there's a default watch list. I suggest is create a second watch list, add the share codes into it, the shares that you want to follow, and then from there you go back and delete the first watch list. But you can see from this watch list here, this is intraday. You can see most of the shares in this situation are red compared to the previous day. So that's what I'm looking at here. It's a nice way to start, as I say, create 3 different watch lists. I like to call it mining or resources, financials, industrials. So you might find your financial shares are down and your resource stocks are up. So where there's smoke, there's fire. So there's one way to focus on opportunities. Okay. So that's where I say what I believe is the watch list is you're putting yourself in the starting blocks. Before you start looking at analyzing the company, create your watch list. Nice thing about the watch list, by the way, it's a big time saver. Okay, you click on the share code, it takes you through to what I call a company analysis. And that brings us to the second step in our process here. I've narrowed down the choice. Now I'm going to gather more information. I like this one company, and I click on a company called Hold Sport. So the share code there was HSP. A lot of people have never heard of Hold Sport, but you might have heard of the company called Sportsman Warehouse, or you might have heard of the company called Outdoor Warehouse. That's the brands of this company. So that they are retailers. So this is a report written by a company that works with us, Independent Fundamental Research. They give you a bit of a background about the company, the nature of the business. They comment on the company's latest financial results. But more importantly, they give you a recommendation. In this situation, buy long term. And they will give a section there on recommendation. They'll tell you why. So yes, it's all all about the numbers. Okay, this is what we call fundamental analysis. Looking at the financial statements of the company and looking at the health of the company and looking at the growth prospects. That will give you, you'll get that from the numbers. Okay, so this is part of the process of going through the gravel. You want to find shares that are giving you the opportunities. Okay. But going back to our watch list again, I can click on the different columns and I can rank them. But I find it useful. There's a little button here called View as Investor. Once I've got his watch list available, I click on View as Investor, and then I can rank it and all the different columns. And now I can start looking at things like what I call the PEG ratio. A lot of us are aware of the PE ratio. Okay, PEG ratio, I want to focus on shares that are green. Okay, those are the shares that are undervalued. That's just an example. But now I can focus on those shares and I can tweak it a bit longer. You know, you see some of the shares are yellow. Those are the shares we classify as fairly valued. Now, once in a while, you might find shares that are red. Those are shares that are overvalued based on certain criteria. But it's a big time saver, the watch list. Okay, and from there, you can start choosing shares to trade and things like that. So we spoke about fundamental analysis. This is a criteria just to get you started. We spoke about a PE ratio. The average of the market right now is about 18. You're looking for shares below that. Anything lower than 18, from a value point of view, that gives you opportunity. From a profitability point of view, I'm looking for shares giving you a return on equity more than 15%. And interest cover, that's when we talk about risk management. I want to see interest cover more than 3 times. Less than that, too risky for me, I get out. Okay. So that is step 2. Step 3, I want to look at technical information, the charting. Now, again, 3 steps. I like to look at 3 criteria. From an equity point of view or shares, the trend must be trending up, must be overbought or oversold. Ideally, I want to buy at the bottom of the cycle when it's oversold, okay? And ideally, I'm looking for shares outperforming relative to all other shares in the market. So how do I know it's trending up? I use things called cycle analysis, moving averages, trend lines. Those are very basic tools to help me determine what's a trend. When it comes to when we talk about overbought and oversold, we use various technical indicators, be it RSI, stochastics. I like to use MACD. That helps me look at the price action. And the other side of the equation when it comes to technical analysis is volume. Okay, volume is the number of shares traded. I can look at on-balance volume and volume price trend. Okay, those are just various tools that help me determine where are we in the cycle. And then I use relative strength to help me also find the shares outperforming. So here's an example. Here's Sasol. So yeah, first of all, what I call trend lines. I connected the lows together, what I call support. As long as the share price stays above that support trend line, I'm supporting the prices and the trend is up. Okay, there you can see a sharper angle, but it's touched quite a few times and the trend is up. Okay, sorry, I just want to get rid of this quickly. Oops, go back, sorry. You can also use moving averages as long as the share price stays above those moving averages. In this situation, I'm using a 50-day and a 200-day moving average. The trend is up. But recently, it's hit a new high. I anticipate to break up above that high very soon. New highs are okay on making new highs. I spoke just now about buying low and selling high. Sasol might present the opportunity soon where you can buy high and sell high here. So what's important also, ideally you want to buy as close to the bottom of the cycle as possible. So this is where the second graph at the bottom here. Oh, sorry. Pushing the wrong button every time. If you highlight here, this is what they call an oscillator. It moves above and below zero line. Ideal situation, you'll buy as close to the bottom of the cycle here. That's that highlighting there. Same here, highlighting that low there. I'm a bit more conservative. I like to cross over the zero line. So yes, I might miss the first 10% and I might miss the top 10%. But that gives me a confirmed signal. I'll be watching it very closely from the bottom here. And it bounced off for the third time. So this is how you start betting the odds in your favor. This is what they call volume price trend. As long as that trend confirms the price trend, I'm looking at accumulation. That also, and together with outperformance, that was our deal time to have bought Sasol in April this year. We're talking about 376 Rand a share. We're close to 500 Rand a share now. Okay. So that is step 3. Step 4, now I've done my homework and I've started to tweak my portfolio. Now some shares are starting to jump out. I don't know what shares I want to buy. On paper, I want to say, okay, I want to buy between 8 and 12 shares. By the time you get to the simulator, or the time you get to your trading account, you've done your homework. Hopefully you've done your homework. So yeah, I've selected the simulator. You'll see that everybody has 100,000 Rand. This is play with fictitious money. The idea is that you want to buy and sell in the risk-free environment and gain the practical experience, first of all, how to place trades. More importantly, for you to gain confidence in your stock picking abilities. If I buy a share today, tomorrow I know if I'm right or wrong because the share's either gone up or down. If you do make a mistake, you have a facility where you can reset it. Try not to reset it too often. The idea is to imagine this was real money. What would you do if you made a mistake? You have to sell, take it, knock on the chin, learn from the lesson and move on. Okay, but how does the platform work? Once I've selected the simulator, I select a little button here called New Order. I enter the share code. I believe if you don't know what the share code is by this point in time, you haven't done enough homework. Okay, so yeah, in this situation, I'm buying some Anglo Vol. It's a food company. Gives me the bids and offers. Okay, the buyers and sellers. And as I say, if you've done your technicals, you know what level you want to buy at. So in this situation, I want to select buy. I've got 100,000 Rand. I want to buy 10 different companies. So on paper, I've allocated roughly about 10,000 Rand to each share. So I have 300 shares at my price. Remember, it's always in cents. Okay, so I want to buy at 30 Rand 36, and I click on submit. Remember, the stock market, I need a willing buyer and a willing seller to agree on one price to make a transaction. So I click on submit, it goes into what we call the order book. Click on order book, there's my transaction waiting there. I want to buy 300 shares at 30 Rand 36. You can see it's trading very close to it. So lo and behold, there's a willing seller to agrees on that price. Next minute, I click on the portfolio button, okay, and there's my transaction. So there's my 300 shares. I bought it at 30.36. You see my cost is much higher. That's my break-even point. So there's what I bought it at. That's the cost price. Okay, so at this point in time, obviously 100% of my portfolio is in one share. But obviously I've only allocated roughly about 10% to the company. There's my costs. Remember, you're buying real shares under real trading conditions, the risk-free. So this share has to move up 1.46% on cost to break even. So people always ask me now, when would I sell? You know, if you want to make 5 Rand profit, that's crazy. You know, your technicals, your charts will tell you when to sell. Now, thinking about the simulator, by the way, we give you some feedback. So it's a learning tool. So we're looking at more risk management. Are you using stop loss? Are you using the structure? Are you using the spread? Okay. Anyway, guys, that is the process. Very simple. It's a four-step process. Remember, narrow down the choice. I've looked at the top 100 companies. When you're first learning about the market, but ultimately, if you can make money with the top 100, you can make money with any of the other 400 companies. Okay. Remember that the idea is to use 3 or 4 different criteria. I use 4 different strategies to help me prospect for opportunities. I scan the market using technicals. I scan the market using fundamentals. But I also use the top-down approach daily, and I also use the newspaper. So I'm always looking for opportunities. Remember, my goal is to find a watch list and tweak that watch list for the potential winners. Once I've got that watch list in place, okay, from there it's all time saving. I can click on the links, takes me through to a lot of information. But my goal is to find undervalued, profitable, and companies with manageable risk. That's from a fundamental point of view. Obviously, it goes into more detail. From a technical point of view, I'm looking for shares in the bullish trend, must be rising prices, must ideally at the bottom of the cycle, oversold, and ideally outperforming the market. That's the 3 criteria I'm looking at technicals. And the 4th step is when I look at risk management, I talk about the 3 S's. I structure my portfolio. Am I going to be more in large caps, as the top 40 stocks, or am I going to be in the next 60 companies, what they call mid caps? Okay. Ultimately, you know, in a real portfolio, you might even have some small caps in there. But the spread, as I say, across 3 to 5 different sectors, and you're going to have between 8 and 12 different shares in your portfolio. Now, with the simulator, we don't really have a stop loss facility. We have what I call a price alert. but you can use a facility where if the price drops 10%, you can be alerted by SMS or by email. Okay. I suggest that you do use a stop loss when you're first starting out, minimizing your losses to 10%. You want to go more than that. Okay. So guys, that is basically the presentation tonight. Upcoming webinars, I spoke about derivatives tonight. Some of you might say, what the hell is a derivative? Might be over your head. So on the 22nd of October, it's a Tuesday night, like we're having tonight, from 6 o'clock until 7 o'clock, I'll be discussing single stock futures, CFDs, Aussie trading, and things like that. It is a repeat of the presentation I did lunch hour, beginning of the month. So those of you who might have missed it, here's the opportunity to get involved there now. I did touch on fundamental analysis very briefly tonight. Hopefully I whetted your appetite. But on the 30th of October, I'll go into more detail. This is our lunch hour one, power hour between 1 o'clock and 2 o'clock. I'll go into more detail, how to read the financial statement, the income statement, the balance sheet, and the cash flow statement. More importantly, I look at various financial ratios. I touched on about 2 or 3 tonight. Obviously, there are more than 20 financial ratios you can use. Then, beginning of November, I'll be discussing Japanese candlesticks. This is a presentation I did right in the beginning of the year. It was one of the only presentations I ever had a full house. 100 people booked and 100 people attended. It's obviously very, very popular. A lot of people asked me to repeat it again because I missed out. So this is for the serious technical traders, Japanese candlesticks. And then we go back to fundamentals again. End of November, we talk about value investing and growth investing. That will be the strategy, investment strategies. And then my last one for the year, I'm coming back to what I call the lost art of point and figure charting. Similar to Japanese candlesticks. Candlesticks have been around for about 1,000 years. Point and figure charts, or noughts and crosses, have been around for about 400 years. Okay, so remember, these things are limited to the first 100 people. So first come, first serve. Okay. In my last 2 traders forum meetings, this is actually face-to-face meetings that you have with me. I've just done one now in Durban. Thanks to the guys in Durban for attending. My next one now is in Joburg. This will be the last one for the year, end of November. And then my last one for the year will be in Cape Town, the 10th of December. Again, you need to book a seat. They're very well attended. The idea is here, this is where we talk about the market in general, opportunities and things like that. Okay. So people, my objectives of this webinar tonight was to show you how to maximize your returns. Now, if you're doing your homework based on fundamentals and technicals, you're doing more homework, you're doing more research, yes, time consuming, but you're being the odds in your favor. That's how you're going to, first of all, minimize your returns, minimize your risk by educating yourself. So yes, your goal is capital growth and dividend income. I suggest you focus on quality stocks. We're talking about companies that are consistent in their earnings, but also we look at shares that are undervalued. These are the companies that have the growth potential. So that is the one side. On one side of the coin, I want to maximize my returns. Other side of the coin, I want to minimize my risk. So by learning more about the market, that's how you'll be doing that. So you want to spread your risk, as we talk about diversification. And we talk about market-specific risk. That's in case the whole market drops or the share drops, you want to use a stop loss to get out. Okay. So finally, objective of this webinar was to lay a foundation. It's basic share market concepts. I suggest go into the online tutorial, goes into more detail. But my goal tonight was to explain a very simple share selection process, to give you a quick overview of the process. As you gain more knowledge regarding fundamentals and technicals, you'll add more stricter criteria for yourself, and over time you'll hone your abilities to pick and choose, or what they call stock pick. Okay. So guys, let me just see if there's any more questions coming up before we wrap this all up. I hope you found this beneficial. So this presentation has been recorded and will be sent out to you guys together with the presentation, together with the PowerPoint presentation. So there's some more questions coming through here. There's a question from Tracy. How do you view an undervalued share? How do you look for an undervalued share? There are various criteria. I suggest once you go into our website, click on research. and there's a little button there called search. And I suggest use the shortcut key to look for undervalued profitable shares, and it spits out a list of shares for you that are undervalued really. It's all color-coded for you, Tracy. You're going to go over the shares that are green. Most of the shares are fairly valued right now, but you want to avoid the reds. So it's like color, get us paint by numbers. Yeah, you got invest by color. Avoid by the greens, simplified. But to answer your question, remember the fundamental webinar coming up soon, and there's also a fundamental value investing webinar coming up soon, Tracy. So that will give you more insight. Okay. Here's a question from, I think it's Morami. Are there any additional costs for using the watch list? So, yeah, when you first register for a free trial, as the word implies, it's free. After 30 days, you need to register and open up a trading account with PSG. And I always joke, what does PSG stand for? It stands for Profit So Good and People So Great. So we're great people. We just won the Stockbroker of the Year 3 years in a row now. So, come join us. So to answer your question is you need to open up a trading account. You don't have to start trading straight away. You just have to go through the whole FICA process. The worst case scenario is going to cost you 40 Rand a month in admin fees. Okay, while you're still learning about the market. So to answer your question, that's what the worst case scenario, 40 Rand. Is there a way we can get the recorded version of this webinar? I think I've answered that already. Thanks, Anne. Pleasure. Thanks, Henry. Thanks, Sean. Great presentation. Okay, that looks like most of the question. Thanks, Leon. Appreciate it. Okay. But guys, any questions you guys have, here's my email address, and there's my direct phone number. We're not allowed to give specific investment advice, so don't phone me and say what shares do I recommend. You come with your analysis and say, Sean, I'm looking at Sasol's. You're welcome to bounce ideas off me. But I use the porcupine approach. I want to know what you've done. Okay. So, guys, I hope you've enjoyed this. Here's my disclaimer. Any shares hinted tonight was, remember, it's just for education purposes only. It was nothing to solicit a trade from you guys. But I hope you guys enjoyed it. I'll be sending this presentation out to you in the next 2 or 3 days. Okay. But thanks a lot. Thanks for your support. And we'll talk again. All the best. Bye-bye.